There's a dividend ETF that has quietly beaten SCHD over the last 1 year, 5 years, and 10 years. And it's not the one you think. It's not VYM. It's not HDV. It holds 445 stocks. It has Apple in its top 10. And somehow, despite being called the Dividend Growth Fund, its dividend actually grows slower than SCHD's. That contradiction is exactly why you need to pay attention. Because this ETF is doing something different, and the results are hard to argue with. Quick disclaimer, I'm not a financial advisor and this isn't financial advice. Always do your own research before making any investment decisions. Today I'm breaking down DGRO versus SCHD. Not just the surface level numbers, but the actual mechanics underneath. How they pick stocks, how they weight them, why one pays more income and the other builds more wealth. And by the end, you'll know exactly which one fits your strategy, or whether you actually need both. But the performance gap I'm going to show you at the 70% mark. That's the number that might make you rethink everything. Let's start with what SCHD actually does, because most people own it without fully understanding the machine underneath. SCHD tracks the Dow Jones U.S. Dividend 100 Index. It takes every stock in the broad U.S. market that has paid dividends for at least 10 consecutive years. Then it runs them through 4 quality screens: return on equity, cash flow to debt ratio, dividend yield, and 5-year dividend growth rate. The top 100 stocks that survive get in. Everything else gets cut. That's why SCHD only holds 104 companies. It's picky, it's concentrated. And that concentration is a feature, not a bug. It means every stock in SCHD has been vetted for financial strength. Now here's what DGRO does differently. DGRO tracks the Morningstar U.S. Dividend Growth Index. Instead of demanding 10 years of payments plus quality screens, DGRO only requires 5 consecutive years of dividend growth. Not just payments, actual increases. And instead of picking 100 winners, it lets in everyone who qualifies. That's why DGRO holds 445 stocks. It casts a net more than 4 times wider than SCHD. But the weighting is where things get really interesting. SCHD uses a modified market cap system. Bigger companies get bigger positions, with some caps to prevent dominance. DGRO uses something called dividend dollar weighting. It weights companies by the total dollar amount of dividends they pay. Not yield, not growth rate, just raw dividend dollars. What does that mean in practice? Companies that are massive and pay huge dividends rise to the top. So DGRO's biggest holding is ExxonMobil at 3.67%. Johnson & Johnson is second at 3.24%. And then Apple at 2.7%. Wait, Apple in a dividend ETF? This is one of the biggest differences between DGRO and SCHD. Apple's dividend yield is tiny, well under 1%. SCHD's index would never let it in. But Apple has grown its dividend every year for over a decade, so it qualifies for DGRO's growth requirement. And because Apple pays billions of dollars in total dividends, even at a low yield, the dividend dollar weighting pushes it into the top 3. That single stock explains a lot about why DGRO's total returns look the way they do. When tech runs, DGRO runs with it. SCHD doesn't have that exposure. Now let me show you the income side, because this is where SCHD flexes. SCHD's trailing 12-month yield is 3.37%. DGRO's is 2% flat. On a $100,000 investment, that's the difference between $3,370 a year and $2,000. SCHD pays you $1,370 more per year in dividends from the exact same investment. For Harry, let's say he's looking for income in retirement. That gap is massive. $343 more per quarter. Enough to cover a car payment or a month of groceries. If income today is your priority, SCHD wins this round and it's not even close. But here's where the plot flips. SCHD's 5-year dividend growth rate is 10.6% per year. DGRO's? 9.2%. So SCHD not only starts with a higher yield, It's growing that yield faster. The fund, literally named Dividend Growth, is being outgrown by the competition. That sounds like SCHD should win everything, right? Except it doesn't. Over the last 12 months, DGRO returned 17.22%. SCHD returned 15.24%. DGRO wins by nearly 2 full points. Zoom out to 5 years. DGRO's annualized total return is 12.25%. SCHD's is 9.69%. That's not close. DGRO is beating SCHD by over 2.5 points per year for half a decade. And over 10 years? DGRO returned 14.35% annualized. SCHD returned 12.8%. DGRO wins again. So the fund with less yield and slower dividend growth produces more total wealth. How is that possible? 2 words: capital appreciation. DGRO's broader holdings include more growth-oriented dividend payers, companies like Apple, Microsoft, and Broadcom, that might pay small dividends but deliver massive share price gains. SCHD's quality screens filter for high yield and strong fundamentals, which tends to favor value stocks. Value stocks pay more in dividends but appreciate more slowly. This is the fundamental tension in dividend investing that nobody wants to talk about. Do you want more cash in your pocket every quarter? Or do you want your portfolio to be worth more in 10 years? Because right now, you can't have both from the same fund. Let me put numbers to this. Harry puts $100,000 into DGRO. If it continues near its 5-year historical average of 12.25% total return, that investment could potentially grow to around $178,000 in 5 years. Meanwhile, the same amount in SCHD at its historical 9.69% could potentially reach about $158,000. That's roughly a $19,000 gap, favoring the fund that pays less income. Stretch that to 10 years using their 10-year averages. DGRO at 14.35% could potentially turn $100,000 into around $384,000. SCHD at 12.8% could reach about $332,000, a $50,000 difference. But Harry collected significantly more dividends from SCHD along the way. Over 10 years, SCHD's higher yield means he potentially pocketed tens of thousands more in cash payments, money he could spend without selling a single share. So who wins? It depends entirely on what Harry needs. If Harry is in retirement and needs to live on dividends without selling shares, SCHD. Higher yield plus faster dividend growth means more spendable cash every quarter, and that gap only widens over time. If Harry is building toward retirement and reinvesting every dividend, DGRO. The superior total return compounds harder when you're not withdrawing. By the time Harry needs income, his DGRO position could be worth significantly more, and 2% of a bigger number might actually pay more than 3.37% of a smaller one. And here's an option most channels won't tell you about. You don't have to pick just one. A 60-40 split, 60% DGRO and 40% SCHD, gives you DGRO's growth engine for wealth building, plus SCHD's income floor for stability. The overlap between the two funds is relatively limited because they use completely different selection and weighting methods. You're not just doubling down on the same stocks. SCHD costs 0.06%. DGRO costs 0.08%. A blended portfolio would run you about 0.07%, less than what most people pay for a single actively managed fund. The real insight here isn't which fund is better. It's that most dividend investors are having the wrong conversation. They're debating yield versus yield, when the actual question is, what phase of investing are you in? Growth phase? DGRO's total return advantage does the heavy lifting while you reinvest. Income phase? SCHD's yield and dividend growth deliver the cash you need. Transition phase? Use both, and shift the allocation as your timeline changes. The worst thing you can do is pick a fund based on someone else's timeline. Your dividend strategy should match where you are, not where a YouTube comment section tells you to be. If you want to see how VYM compares to both of these, and why 86% of SCHD actually lives inside it, that video is right here. And if this changed how you think about building a dividend strategy, let me know in the comments.